Gold and silver just surged to record highs in US trading. Then, in a sudden reversal described as a flash crash, they fell hard, fast, and in a way that immediately raised fresh questions about what changed inside the market within minutes. Gold and silver prices have pulled back sharply after a record-setting surge in the United States, with trading on January 30th marked by a sudden, steep drop that the report describes as a flash crash. The moves followed what the report calls a historic rally that carried gold to an all-time high of $5,600 per ounce and silver to $122 per ounce in U.S. trading. The same report says the speed and size of the reversal drew immediate attention because of the scale involved, and because the decline unfolded quickly after those new highs were reached. According to the report, the price swing was so abrupt that the estimated value of above-ground gold shifted by more than $3 trillion within minutes, in a market atmosphere linked in the report to tensions between the United States and Iran. In the reports telling the environment was already strained, and that broader tension formed part of the backdrop as precious metals ran to extreme levels and then snapped lower. After that rapid move, the report says the market showed a brief resurgence on Friday, with gold recovering to around $5,300. That rebound did not hold. The report describes a second leg lower that pushed gold back under $5,000, reaching $4,141. It characterizes that move as a roughly 7 to 8% decline on the day. The report also notes that the sharp drop was concentrated primarily in COMEX futures and in paper silver contracts, highlighting the role of derivatives trading and how the decline played out. The report frames the sequence as a dramatic change in direction. First, a record-breaking run to new highs, then a sudden and forceful reversal. While both metals are described as showing a flash crash after the rally, the report's most specific intraday detail centers on gold's retreat from a recovery near $5,300 down to $4,141. In that same context, it emphasizes that the intense movement was most visible in futures and paper markets, rather than being presented as a gradual adjustment. The overall message is that the rally reached extreme levels and then, within the same broader session, reversed in a way that the report portrays as unusually fast. As the report presents it, this episode is prompting a fresh set of questions about what drove the sudden plunge. It introduces the idea that the precious metals market may be undergoing what it calls a potential structural shift. In that framing, analysts are cited pointing to several possible contributors, including profit-taking after record gains and a modest rebound in the US dollar. The report also links the market's volatility to a major leadership change at the Federal Reserve, stating that a new Fed chair has been appointed, Kevin Warsh, replacing Jerome Powell. Alongside that, the report adds that President Trump's Fed chair decision, and the way it was handled publicly, contributed to the volatile conditions that surrounded the trading. At the same time, the report emphasizes that not everyone focuses on those conventional explanations alone. It says that many are pointing toward what it calls a darker possibility, market spoofing, which the report describes as illegal only if it can be proven. The report does not present that as a confirmed finding. Instead, it describes the concept as part of a broader set of concerns raised by the pattern of record highs followed by sudden crashes. In the report's wording, the combination of dramatic peaks and equally dramatic drops creates an effect designed to pressure less capitalized or less prepared participants out of their positions, a phenomenon the report links to the market's volatility. The report also introduces the possibility of market manipulation and forced liquidation as themes that, in its view, may be tied to the speed of the decline. It refers to subtle indications of manipulation and describes a dynamic in which rapid price drops can force some participants to exit positions quickly. As part of that broader discussion, the report cites Oxfam, stating that the top 10% hold about 93% of U.S. households' stock market wealth. That statistic is presented as background for a hypothesis discussed in the report about who may have the ability to influence market conditions when liquidity is strained and prices are moving quickly. The hypothesis, as laid out in the report, suggests that ultra-wealthy market participants could be triggering mass liquidation by selling very large quantities of futures contracts in a way that overwhelms buy-side liquidity and accelerates a price drop. The report describes a chain reaction. As prices fall sharply, retail investors may be required to post additional cash to maintain their positions, and those unable to do so risk automatic liquidation. In that scenario, the report says, one forced sale can lead to another, producing a cascading effect that deepens the decline. The report further suggests that after a brief reprieve, another downward move could follow, with the aim of pushing out remaining participants. This sequence is presented within the report as a hypothesis describing how extreme volatility might be created and sustained through market mechanics. In describing why such a pattern might matter, the report states that this kind of repeated crash behavior could prevent gold and silver from reflecting what it characterizes as weakness in fiat currency, and it asserts within the same discussion that the dollar's fiat regime is heading toward a fall. That assertion is not presented in the report as an established outcome supported by disclosed evidence. Rather, it appears as part of the overall narrative connected to the hypothesis about deliberate pressure in precious metals pricing. The report's broader point is that the extreme moves are being interpreted by some observers not merely as ordinary profit-taking, but as part of a larger struggle over market signals during an already tense environment. To support the hypothesis, the report points to what it calls convenient timing. It highlights that gold reached an all-time high of $5,600 and then fell by $500 in the same session. It also notes an additional development the following day, saying China halted trading in 5 commodity funds in an effort to limit risk and volatility, a step the report describes as isolating its market. The report presents these details as indicators cited by those who suspect that the sharp reversal was not random, even as it acknowledges that such claims are difficult to confirm. The report is careful to underline that this territory remains speculative and hard to prove. It attributes that difficulty to the market's opacity and the anonymity associated with free trading. Even while discussing the possibility of manipulation and forced liquidation, the report does not claim definitive proof. Instead, it frames the idea as a hypothesis and notes that the evidence is largely circumstantial as presented. The report also describes how, if swings intensify, banks and market makers could struggle to maintain liquidity, retail investors could panic and sell, and institutional investors could take advantage of the conditions. Those statements are included as part of the report's depiction of how volatility might affect different groups if the sharp movements continue. This is the picture the report draws. Gold and silver hit record highs in the United States, followed by a rapid flash crash on January 30th, including gold's retreat from a rebound near $5,300 to $4,141, a 7 to 8% daily drop, with the most visible pressure centered in COMEX futures and paper silver contracts. It then outlines a range of suggested drivers, from profit-taking and a firmer dollar to the report's statement that Kevin Warsh has replaced Jerome Powell as Fed chair, and it notes the report's portrayal of President Trump's Fed chair decision as contributing to heightened volatility. Finally, it lays out the report's discussion of spoofing, liquidation dynamics, and the speculation surrounding large-scale futures selling, while also stressing that these claims are difficult to prove in an opaque and anonymous trading environment. The report's account of events begins with a rapid climb that pushed both gold and silver to new records in U.S. trading, and then shifted just as quickly into a sharp decline described as a flash crash. In the report's telling, the move higher was historic in scale, with gold rising to an all-time high of $5,600 per ounce and silver reaching $122 per ounce. Those highs, as presented, were not treated as a slow or ordinary advance. They were described as the peak of a record-breaking rally, followed almost immediately by a violent pullback that raised urgent questions about what had changed in the market within the span of a single session. According to the report, the intensity of the move was reflected not only in price, but in the implied value shift across the gold market. It states that the estimated value of above-ground gold swung by more than $3 trillion within minutes. That figure, as it is presented, is intended to capture how sudden and wide the price adjustment was. The report places this episode in the broader context of heightened tensions between the United States and Iran, describing a market environment already under strain as the rally reached new records and then rapidly reversed direction. The report's timeline then turns to what happened after the first drop, describing a brief attempt by the market to regain stability. It says that on Friday, prices showed some resurgence, with gold recovering to around $5,300. In the report's account, that rebound did not hold for long. The move lower resumed, and gold fell again, dropping below $5,000 to $4,141. The report characterizes that as a daily decline of roughly 7 to 8%. The sequence described is clear: an historic high at $5,600, a pullback, a partial recovery toward $5,300, and then another steep decline that carried the price down to $4,941. While the report references both gold and silver as having experienced a flash crash on January 30th, it draws particular attention to where the sharpest activity was seen. It says the crash occurred primarily in COMEX futures and paper silver contracts. In that framing, the report is specific about the type of trading where the plunge was most evident. It ties the price shock to futures and paper markets, and it highlights that much of the extreme movement was concentrated there as prices shifted rapidly from record levels into a steep decline during the same broader trading window. From there, the report moves from what happened to the question of why it happened, and it introduces the idea of a possible change in how the precious metals market is behaving. It states that what is unfolding may reflect a potential structural shift in the market. In presenting that view, the report points to analysts who cite several factors that, in their assessment, could have contributed to the sudden reversal. The report does not narrow the cause to one confirmed trigger. Instead, it lays out multiple explanations that are being discussed at the same time, set against a backdrop of record highs and abrupt, unstable price action. One of the reasons mentioned in the report is profit-making after the rally reached new highs. The report describes this as a factor analysts are pointing to as prices retreated sharply after the record run. It also notes a slight rebound in the US dollar as another element being cited in connection with the timing of the move. In the report's framing, these points are presented as part of the initial, more conventional set of explanations for why prices might fall quickly after an extraordinary rise, especially when the market has just posted new records and trading conditions are already unsettled. The report also links the volatility to a significant leadership change at the U.S. Central Bank. It states that a new Federal Reserve chair has been appointed, naming Kevin Warsh, and it says he replaced Jerome Powell. In the report's narrative, this change is part of the environment in which the flash crash occurred. It further adds that President Trump's approach to the decision contributed to the volatility, describing the handling of the Fed chair choice in terms that emphasize its public, high-profile nature. The report says these elements came together alongside the other factors being discussed, forming what it characterizes as the backdrop to the volatile market activity. As the report presents it, this combination of record pricing, a quick reversal, and heightened uncertainty created conditions in which sudden moves became possible. It ties together several strands: the surge to an all-time high, the sharp drop, a brief rebound, and then another decline that pushed gold down to $4,141, described as a 7 to 8% fall on the day. It also reiterates that the primary arena for the crash was in COMEX futures and paper silver contracts. The report's overall emphasis remains on the speed and scale of the move, and on the idea that multiple developments were being discussed at once as possible contributors to the abrupt downturn. At the same time, the report makes clear that there are competing interpretations of what drove the crash, and it indicates that not all observers are satisfied with the explanations focused on profit-taking, currency movement, or central bank leadership change. It introduces the notion that some believe the pattern of record highs followed by sudden, steep drops may be connected to other forces. In the report's language, the pairing of record highs and flash crashes has created what it describes as a shock and awe situation, and it notes that such conditions are often grouped under the market term volatility. The report links this environment to the possibility that weaker positions can be forced out in fast-moving sessions, while acknowledging that the darker claims discussed are not straightforward to prove. The report further signals that questions around manipulation and forced liquidation are part of the discussion surrounding this event, while maintaining that these ideas are within a speculative zone. It emphasizes that proving wrongdoing can be difficult, and it references the market's opaque nature and the anonymity of free trading as reasons why proof can be hard to establish. It also notes that market spoofing is illegal only if it is proved, and it presents that point as part of the wider set of concerns raised by the sudden drop after record highs. In this portion of the report's narrative, the focus is on the fact that these claims are being raised, not on any confirmed conclusion. The report's account, up to this point, centers on the key sequence of prices and the main explanations being cited at the outset. A record-breaking surge to $5,600 for gold and $122 for silver. A sudden flash crash on January 30th. A brief rebound toward $5,300 for gold, and then another decline under $5,000 to $4,941, described as a 7 to 8% daily fall, with much of the sharp activity concentrated in COMEX futures and paper silver contracts. It then connects the volatility to a mix of factors including profit-making, a slight rebound in the dollar, and the report's statement that Kevin Warsh replaced Jerome Powell as Fed chair, alongside the report's description of the way President Trump's decision unfolded publicly. For now, the report leaves a clear sequence on the table: record highs, a flash crash, a brief rebound, and another steep leg lower, while the debate over what truly drove the plunge remains unresolved in a market the report describes as opaque and difficult to prove wrongdoing in. If you want more updates and breakdowns like this, like, comment, and subscribe,